Greetings of the day to the viewers of this webinar. I'm Anurag Negi. I'll be taking up today's webinar on derivative spread contracts. So let us begin with understanding what the basic agenda of today's webinar is. So we will cover the basic concepts related to spread contracts and spread trading. Then we will understand what is futures calendar spread. Then we'll understand various features of it. Then we will dwell into what are types of calendar spreads. Then we'll look at the advantages. So what are derivative spreads? Before getting into what are derivative spreads, let us try to understand what derivatives are. What does exactly a derivative mean? So a derivative is nothing but a financial contract which derives its value from an underlying asset. Various types of common derivatives are futures, options, then forwards, swaps. All these fall under the category of derivative contract. So it essentially means that derivatives do not have their own value. They derive their value from an underlying. So this underlying could be anything. It could be a commodity. It could be the shares of a company. It could be anything. So now, when we talk about derivative spreads, derivative spread in itself is a vast term because there are a lot of types of derivative spreads. For example, in options, there are various spreads. Option is a type of derivative. So there are different types of spread in options. For example, there's butterfly spread, there is bull spread, bear spread, right? So there's calendar spread. And if we talk about futures, calendar spreads are also there in futures. So today we are going to understand more on the futures spread contracts. Before getting into that, let us first try to understand what futures are. So futures contract is a legal agreement to buy or sell a particular commodity or an underlying at a specific future date at a predetermined price. That's what a futures contract is. So essentially futures is a type of derivative, but futures is a legal agreement. It's a standardized contract. All right. So futures are traded on exchange, and it is by standardized, I mean it has a specific date, predetermined price, and things are like really standardized in a proper format. So let us understand what are future calendar spreads. So calendar spread is a trade whereby a trader simultaneously enter into opposite positions on different calendar month contracts. Aim of spread trading is to gain profit from widening or narrowing of the spread between two related futures contracts. So calendar spread is nothing but a trade wherein a trader or an investor simultaneously enters into two different positions, which means essentially if there's, let's assume, a January month expiry of any futures contract and there is February month expiry of any futures contract. So if a trader gets into a position which involves both of these contracts and he's buying one and selling the other contract, that is essentially called a calendar spread. So aim of calendar spread trading is to profit from widening or narrowing of spread between two related futures. What does this statement means? This statement essentially means that let's assume that the February futures contract is trading at 110 rupees and the January spread contract is trading at 100 rupees. So if a trader buys a Feb contract and sells Jan contract, that means he's buying a spread. And the spread is 10 rupees, that is 110 minus 100. So the value comes out to be 10. Now let's assume a random scenario wherein after 3 days, the February contract goes from 110 rupees to 120 rupees. And the Jan contract increases from 100 rupees to 105 rupees. But the spread now in this case has gone to 15 because 120 minus 105. The difference is 15 rupees. So essentially a trader who had bought the spread at 10 rupees has made a profit of 5 rupees because now the spread value has gone to 15 rupees. So this is how a trader makes money. In this case, in our example that we took, the spread widened and in return, the trader or the investor who traded or invested in that spread made money. Now, what is a buy spread order? Buy spread order is nothing but when a trader or investor buys far month and sells near month. That is called a buy spread order. So essentially, if I have to again go back to the previous example that I just gave, the investor is buying February month and selling Jan month. That is called a buy spread order. And what is sell spread order? Sell spread order is exactly opposite of this. It means selling far month and buying near month. So in our example, it would be selling February month and buying Jan month. That's what a sell spread order is. Spread trading is also called relative value trading, of course, because I mean, there are two contracts. You are trading relatively both of them, right? There's a relation between them, and you're trading both of them. That's why it is called a relative value trading. Spread as a unit is bought or sold. So you never say that you bought Feb and sold Jan. You will always say you bought a spread or you sold a spread. Talk about it as a one as single one unit. So what NCDX does is NCDX provides you a spread order book, and in which you can directly place an order instead of placing orders through outright. So what exactly I mean is NCDX will provide you an instrument which will be your Jan-Feb spread order book, in which you can directly place orders. So in our example, which we recently took, instead of buying February at 110 and selling January at 100 and creating a spread, NCDX is providing you a spread order book in which you can directly put a buy order at 10 rupees and get it executed. So now we are going to talk about some features of spread order books. Spread order book is available in combinations of underlying futures contract of a commodity. What does that mean? So that essentially means that spread order book is available in a lot of combinations. Let's assume that the outrights, the futures contract are available for trading, are open for January month, February month, then March, April, May. Okay, so there could be numerous spread combinations that are also available for trading. So there could be a Jan-Feb spread order book. There could be a Jan-March spread order book. There could be a Feb-March spread order book. There could be a March-April. There could be a Jan-April, so on and so forth. So all these combination of spread order books are available for trading. Spread trade results in trades in the outright futures contract. Yes, once anybody takes a trade at 10 rupees in a spread order book, then that trades will get devolved into outright trades, right? So if let's say a trader A has taken a trade at 10 rupees in a spread order book, then trader A will get two prices. If trader A is a buyer of Jan-Feb spread order book, then he or she will get a buy order in Feb and a sell order in Jan. That's how it gets devolved. Spread price could be positive, negative, or even zero. Spread price could be anything out of these. We'll see that with an example that I've taken up in the next upcoming few slides, how the spread prices could be positive, negative, or even zero. NCDX provides spread order book market depth. NCDX, of course, as I just spoke, that NCDX provides a separate order window in which it also provides market buy depth. Your 5 price levels of buy, 5 price level of sell would be available, and you could trade directly in that spread order book window. Order matching always takes place as per the price time priority. So what exactly does price time priority means? Price time priority means that essentially, if let's say a trader A placed a trade at 100 rupees to buy, another trader B has placed a buy order at 105. So whenever a sell order will come in this order book, it will always get traded with trader B, who has placed his order at 105, because his price is better than 100. So he will get the price priority. That's called the price priority. Now, what is called time priority? Time priority is nothing but, let's say trader A has put a buy order at 100 rupees at 10 o'clock in the morning. And let's say trader B puts a buy order at 100 rupees, the same price at which trader A had put the buy order, but trader B's order time is 10:15 or 10:20 or whatever. I mean, it is later than your 10 o'clock when trader A had put his order. So whenever a sell order will come in, you'll always get matched with trader A first, because he is before trader B in time priority, because now the prices are same for both the orders. So we will look into the time priority in this case. This is what is called price time priority. So order matching always takes place as per price time priority in spread order books as well. So these are two examples of different outright books. As you can see here, we have soya refined February expiry. The second one on the right side of the screen is soya refined March expiry. And we can see that the prices are roughly around 843 for Feb and roughly 832 for March. So these are two outright contracts, and this is how, 5 levels of buy, 5 levels of sell, that could be seen in both the outright books. Now if we see the spread order book, so this is the spread quote of soya refined for February 2020 and March 2020 spread. So we saw that the prices of the March future was 832, and for February future it's 843. So the differential of it is coming out to be minus 11. So we can clearly see that the spread order book, in spread order book, people have put quotes at minus 11 and around that price. So this is how spread order quotes work. But people, I have put quotes in spread order book as a fresh order. Like if anybody wants to buy spread order, he will directly put quotes in spread order book. So we'll also see the same with the help of an example of guar seed. So as you can see in guar seed, February contract is here on the left of the screen. Then March contract is there on the right side of the screen. So this is two outright futures contract of guar seed. So the price of your March contract is roughly, we can say 4,070, and the price of Feb expiry is, we can say 4,026. Yeah. If we see the differential in this case, it's coming out to be 44. And if we see the spread quote window, the trades are, the spread trades are quoted around 44, 42, the best bid, best offer. Best bid is 42, best offer is 44, right? So this is how people derive the prices of spreads, right? So if, let's say, this differential between these two futures contract was assuming to be 50 rupees, right? If March minus Feb was coming out to be 50 rupees and spread window quotes were, let's assume, 42 or 44, then people would have sold this. That means people would have sold March future and bought February future here in the outrights, and here they would have bought it at 44, because eventually these two have to balance off each other. Either this price of 42, 44 would come to 50, or that price of 50 would come down to 42, 44, or the price differential that is created from here. I'm just taking an arbitrary case. So, or it could, settle somewhere in between at 48 maybe, but this will balance off, right? So, because if this situation cannot happen, if this happens, it's a free arbitrage in the market, but this would be very, very rare to see, very rare. Now moving on, we'll see what are the different types of calendar spread trades. So first there are intra-commodity spreads. Intra-commodity spread is nothing but the previous example that we saw. That means two different expiries, but the commodity is the same. So let's see what intra-commodity spreads are. These spread combinations are traded within different months of a single commodity type. A buy spread or sell spread is created using two different expiry months of futures contract. A common use of such type of calendar spread is to facilitate rollover of positions. This point is very critical. This is very important. They are easier to trade with lower margin requirements. Yeah, of course. So let's see the first point. These spread combinations are traded within different months of a single commodity type. Yes, The example is this: 2 different months, same commodity. Guar seed is the same commodity, March and Feb, 2 different months. Now, a buy or sell spread order is created. Yes. So a buy or a sell spread order is created using 2 different expiry months of futures contract. But now the third point that I was saying that is very critical and important, it facilitates rollover of positions. What does that mean? That essentially means that if anybody has taken a long position, let's assume in January month contract, now a trader or an investor has a long position in January month, and the trader or investor, and the Jan is about to expire, the Jan futures contract is about to expire, and now the trader wants to move his long position from January to the next month, let's say Feb month. So essentially, the investor or the trader wants to make a long position in Feb, but want to square off the January long. So one way of doing it is that the trader or the investor puts two trade. One, the trader sells January month contract and buys February month contract, right? But what if as soon as the trader sells Jan month contract and tries to buy Feb, there's a big move in the market, right? So the trader is exposed to a risk in case when the trader wants to execute both the legs. But the other way of doing it is buying a spread, a Feb Jan spread. If a trader buys a Feb Jan spread, that essentially means that the trader is buying February month and selling January month, right? So a trader can simply put one single quote in Feb Jan contract of a single buy quote. So that will, give him, if that buy quote gets executed, the trader will get a buy position in Feb and a sell position in Jan. And because it already has a buy position in Jan, the buy position in Jan will get set off with this sell position, right? So this is how spread contracts helps to facilitate rollover. They are easier to trade with lower margins, of course. I mean, the margin benefits are given by the exchange for trading spreads. They are, of course, easier to trade. Excuse me. Now let's see what are intercommodity spreads. So intercommodity spreads are nothing but these spreads combinations are formed from two distinct but related commodities. So in intercommodity spreads, two distinct commodities are used. That means two different commodities would be used. The commodity would have some economic relationship between them. Yes, of course, the commodities will definitely have some relationship between them, and therefore they are traded. Common examples of it are the crush spread between soybean and one of its byproducts, reflecting the minimum inherent in processing soybeans into soya meal and soya oil. A lot of traders trade crush spread between soybean, soya meal, and soya oil. Then highly correlated instruments such as Brent crude versus WTI crude. Brent crude and WTI crude are very strongly correlated with each other. So that is one example. Then London white sugar and New York sugar. These two contracts also have like a strong correlation, and therefore people do intercommodity spread between them. And of course, when you trade two contracts on different exchanges, then it is called inter-exchange spread trade. That is also a form of spread trade, but it is called inter-exchange because you are trading two different commodities on two different exchanges altogether. So I've taken a simple example of intercommodity spreads. This example is of lead and zinc. In the example in the graph, you can see that the prices of lead and zinc are moving closely together, right? So the red bar, red line is for lead closing price, the blue line is for zinc closing price, and then the spread, the differential, is the green line. So we can see that the green line is fluctuating close to zero, right, for a long time. So now if you see the table on the right hand side, you will see the closing prices of lead, the closing prices of zinc with the dates and the difference of them, that is denoted by the heading of spread. So on the right hand side, if you see the table, so essentially it's nothing but I have subtracted lead closing price from zinc closing price. So if you see on 7th November, lead closing price is 112.1, zinc closing price is 107.55. The differential, the spread is coming out to be minus 4.55. So now this is how the table is created, and the highlighted portion, that is around 2nd Jan and 9th Jan and 16th Jan, we see that the differential has gone to minus 10. So essentially how spread trades are taken, like if any trader has taken a spread data like this and has found the mean of the differential of lead closing price and zinc closing price, that is the spread, the mean of the spread is coming out to be, let's assume 5 in this case, right? So, and from minus 5, if the differential of the spread is going to minus 10, then that means that ideally the differential should turn around from minus 10 and increase towards minus 5 direction again. So anybody, if in this case, if we see on 2nd Jan, then on 9th Jan and 16th Jan, the differential is minus 10, minus 10. So any trader or investor seeing this could take a long position here and then wait for the spread to go to minus 5 again. So if you see closely, then around the 6th Feb, 13th Feb, the spread has gone to minus 5 again. And that is the time when the investor knows that this is the time when the investor should get out of the trade, right? So this is how intercommodity spread trades are executed. So people refine intercommodity spread trades more, by applying a lot of more filters, more applications, more formulas on top of it. So one of the way of doing it is like finding the mean of the spread that we did already in this example. Then also finding out the standard deviation of the spread. So standard deviation is nothing. I mean, it's just a quantity expressing by how much, the members of a group differ from the mean value of the group. So let's assume in this case, the standard deviation value comes out to be, let's assume it comes out to be minus 1. So now what you can do, or what an investor or trader can do, is like, if the mean is coming out to be minus 5, the standard deviation is coming out to be minus 1, the trader can take a trade and, see that the range in which the range in which the spread should fall would be 1 standard deviation plus minus. So if you do minus 5 plus 1 plus minus 1, it will give me minus 6. If you do minus 5 minus of minus 1, it will be minus 4. So a trader or an investor will be cautious of these two levels. So whenever the spread will go above minus 4, the trader or investor will short the spread, and whenever it will go below minus 6, trader or investor will buy the spread. That's one of the ways of refining or fine-tuning this intercommodity spread trades. So this is how usually broadly how intercommodity spreads takes place. Now let's talk about the advantages. So spread trades eliminate leg risk for spread traders. Of course, I obviously explained that point earlier in the example wherein somebody had to roll his Jan position to Feb position, and when the trader or investor has to roll a long position, so how will that trader or investor do it? By selling Jan and buying in Feb, but if there is a drastic move in the market, right? So that is the leg risk. So that leg risk is eliminated if you directly take a spread trade. Spread is easier to trade. Of course, we'll see that, in forthcoming example that I have. Then, of course, in the previous example, we saw that spread, they move in a range. So they are easier to trade. They are easier to track. Spread market by price brings in more transparency in the market. Yes, because you get to know what exactly is the differential at which the two different futures contracts are being traded in the market. So it brings in more transparency in the market. Spread trades facilitate easy rollover. We already talked about this point. Spreads are easier to analyze, yes, more predictable and considered less risky as they are less volatile. So this is very critical. I mean, spreads are, of course, they are easier to analyze. They are more predictable because they move in a range, and they are considered less risky because, of course, they are less volatile than your straight outright contracts. Spreads have lower margin requirements. That's again one of the key factors. Like, a margin benefit is given in spread trades. Now, this is the chart of soybean front month rolling contract. Now, if you see in this front month rolling contract, soybean has, this is from January 2016 to January 2020. So if you see, the bottom is close to somewhere around 2600, we can say, roughly, yes. And the top is around 4500, right? So how much points, how much rupees? That's roughly close to 1900 rupees, right? So soybean has moved 1900 rupees, correct? And if you see, if anybody would have taken a trade somewhere here in April 2016 in soybean, that was your how many rupees? 4300. And let's say that person got stuck in that trade and got out of that trade in somewhere in April 2017, although it's I'm just taking an hypothetical situation, right? So what is the price here? It's 2700. So from 4300 to 2700, how much that comes out to be? Let me just quickly calculate it for you. That'll come out to be 4300 minus 2700, roughly a 1600 point gap. So, or I mean, if let's not take such a long time frame. If we take it from here 4300 and we assume it to be just few months, April, July, right? So, or April, somewhere around July. So some 4300 in July itself, mid of July. That's probably August. In August, it has come to roughly 3100. So from 4300 to 3100, that's 1200 points. Correct me if I'm wrong. Yeah, that's some from 4100 to 3100. That's 1200, right? So in a span of 3 months, no, a little more than that, maybe 4 months. In a span of 4 months, the investor could have lost 1200 rupees. Now let's see the same thing in case of a spread. So first of all, if we see the soybean near next month spread, it is broadly moving from minus 50 to 100. Yeah, 100, or we can say 150. So it is moving in that range. It is moving in 150 rupees range from minus 50 to 100 for more than 80% of the trading days. You can clearly see it from this line. And let's see the exactly same example. So let's see in April to we saw April till August. So let's see if somebody would have taken a spread trade in somewhere in little ahead time of April. Let's see here. So from here to here, the person would have lost how much? 150 to this is minus 50, 200 rupees. So in outright, you could have lost 1200 rupees, and in spreads, you're just losing 200. That's like, that's what says that, spreads are less volatile. Their risk is lower than the straight outright contracts. And they are, of course, easier to trade. They are easier to see. They are moving a trend. And in this case, it is moving in between 150 rupees from minus 50 to 100. This is an example of soybean. Even if in the case of guar seed, we can see this is a guar seed front month rolling futures contract from Jan 2016 to Jan 2020. We can see that guar has bottomed around 2900, yeah, roughly 2900, 3000 we can say, and topped here at 4800. So if we say 3000 to 4800, that will be your 4900, actually 2900 to 4900. So that will be close to 2000, right? So Quar has moved to 2000 rupees in price. Whereas if we see the spread from top to bottom, it has moved from 300 to minus 80. That's 380. So 2380. That's what is the crucial factor. That's why spread trades are considered less risky. And then in case of Guar seed as well, we can see like more than 80% of the days the spread has moved in the range of 0 or 20 to roughly 100, and yeah, close to 120. So from minus 20 to, you can say, 100, 80% of the days spread has traded in that range. We can clearly see from this graph. So that's why spread trading is considered more predictable. It is considered less risky, and spreads are considered less volatile. So this is it on spread trading. And I mean, we can see other type of spread contracts. And if you have any questions, of course, you can float them down to the customer service group of our organization. Thank you. That'll be all.